So let's say you bought your house for $200,000 5 years ago, and now it's worth $400,000. You just made $200,000, but you got to pay taxes. Not necessarily. There's two ways, as an investor and as a homeowner, you can sell that property and make money without paying taxes. Let me show you how. So before we start with the two ways to do this, you need to understand that anytime you make money on an investment or on something, there is taxes that are due that you have to pay. Those are called capital gains taxes. There's short-term and there's long-term. Short-term is anything you buy and sell in less than a year. Long-term is anything more than a year. You're gonna have to pay more on taxes if it's a short-term capital gain. So you wanna try to sell within more than a year so you can minimize the taxes that are due. Usually capital gains tax is gonna be around 15 to 20% depending on how much you make and what income tax bracket you're in. Now, knowing those things, it doesn't mean that you have to pay that 15 to 20% because there's certain exceptions and rules that the IRS allows for, and that's what we're talking about today. There is one that you can use for your primary residence if you're a homeowner, and that's an exclusion, primary residence exclusion. The other one is specifically for investors and investment properties, and that's called the 1031 exchange. That comes from IRS code section 1031. Now, we're gonna start with the homeowner's primary residence exclusion, and then we'll get into the investor side. So the primary residence exclusion basically states that if you live in the property for 2 years in the last 5 years, that you would qualify for this. Meaning, if this is the place that you've resided most of the year, your primary residence, and you've lived in that house for 2 years in the last 5 years, you will have to pay nothing in capital gains tax on the sale or on the gain of that sale. Now for single filers, this is only up to $250,000. So anything over that you make in profit, you would have to pay taxes on. And if you're married filing jointly, it's up to $500,000 that you do not have to pay taxes on. So for example, if you bought a property for $200,000 a couple of years ago, now it's worth $400,000. You sell the property. The gain on that sale, let's say, is $200,000, right? Now that's profit that you normally would have to pay taxes on. But if you lived in the house for 2 years at minimum, then you do not have to pay according to the primary residence exclusion. So that's what you want to try to do to be able to take advantage of that tax code. Now, this is also something you can take advantage of if you're an investor living in the home. So what if you bought the home as your primary residence and you rented out the rooms? Or what if you bought a duplex and you lived in one side and rented out the other? Well, you would be able to take advantage of that as well if you lived in that house for a minimum of 2 years within the last 5 years. The 1031 exchange is for investment properties only. So you can't use this on your primary residence. But if you buy an investment property, let's say for $200,000, now it's worth $400,000, you want to sell it, your gain on the sale is $200,000. Well, what you can do is roll that profit and those proceeds into another property that's similar or greater value and pay nothing in taxes on that profit. So this comes with a couple caveats. You have to be able to identify the new property within 45 days and close on the new property within 180 days. You also cannot touch this money. This money that you make from the first sale needs to be put into a special account and be handled by a qualified intermediary. And this person will then manage those funds to put into your new property that you have bought. There is plenty of qualified professionals that can help you with this 1031 exchange, but there are particular ways that you need to go about it. So make sure you always consult with a professional before doing anything like this. But these options are available to you and they're completely legal. So what you could do is take advantage of the primary residence exclusion and also take advantage of the 1031 exchange as an investor who has lived in that property. This means you can take all of your profits and pay nothing on it, whereas you would ultimately have to pay 15 to 20% normally. That's a huge amount of money. Imagine you make $200,000. What's 20% of that? That's $40,000 of taxes that you now can keep in your pocket and roll it into a bigger, better investment property. This is how the rich continue to grow their wealth, because they do not touch their money. They reinvest it tax-free. And imagine now when you're getting into bigger commercial properties where you're talking about millions of dollars in profit, you're saving 15 to 20% in taxes. That's a huge number. And that's how you build wealth for yourself. So next time you're going to sell a property, make sure you're looking over all of your options to take advantage of the IRS codes and exclusions. Talk to an accountant. It's worth the investment. As you can see, if you can save 15 to 20% in taxes by knowing something that you didn't know before, you're going to save yourself thousands of dollars. So for you to invest in an accountant or a tax professional, that's a small price to pay to make sure you do things right. I highly recommend it as you progress in your investment career. And also just in general, there's a lot that we do not know as individuals. Our professions are what we do best. So we should stay focused on that and let the other professionals that deal with this kind of stuff on a daily basis take that into hand. So now that we know this, go out there, save yourself some taxes, make a lot of money, and I wish you guys the best. Thank you for watching. Subscribe to the channel. And remember to keep going, keep learning, and keep grinding.